Hello, everybody. It is noon by my time here in Des Moines, Iowa, Central Time. So welcome. I am here at Prairie Fire headquarters. The background maybe look a little different. I'm not at the Knotty Pine Lounge or Lodge or doing anything like that, but trying a different look for our set and stuff, and trying to make things more aesthetically pleasing and all that good stuff over time here. So thanks for joining us today. Topic, mean markets. Wow. It's been a crazy start to 2022 where things were so pleasant and calm last year and markets just kind of ticked along the way and there wasn't anything too harsh to deal with. We've had just a mess of it this year, and it's not been just one part of the market. When I talk about the capital markets, we were talking about stocks, bonds, gold, oil, energy, inflation, interest rate, all the stuff that's been going on and we've written a lot about has just been, frankly, mean. There hasn't been a lot of places to run, to hide, and can make it really, really difficult to understand what to do in times like these, because there's just so much noise, so much news. And I tell you what, going into last week, I have not heard such negativity in a long, long time. I think back always to this cocktail party I was at the Christmas of '08. And I'm sure we all remember what was going on then, but basically Lehman Brothers had failed. The mortgage market was just gone. Banks were filing bankruptcy over the weekends. It was just a frightening time. And there was all of this. You just never believed it could ever get any worse. And you never believed it was going to get any better. But that was kind of a point in time where I was at this cocktail party and this guy said, things are bad and they're never going to get better. That's how it felt last week, is that things were bad. And man, from everything I read, it's never going to get better. So I want to talk about that today. We'll talk about all of those different dynamics, what I think we should be doing and thinking about in times like these, why this one, they're always a little different. They tend to rhyme sometimes, but they're these time of downturns and challenges always have a few things in similarity. And we can talk about that. As far as logistics go, I do have the chat set up and the Q&A. So if you have questions along the way, if you would post them in there, you can post them just directly to me through the admin function, or you can put them out to everyone. And I will address those as we go along here. I want to start today with a poll. And so I'm going to punch this up here. And it says, from its value on September 30th, do you believe the stock market will be up at the end of 22 or down at the end of 22? So we all know that we've seen declines in the 20%, in some markets, 30% plus in the NASDAQ, QQQ, some of those areas. So I'd be interested to see what everybody thinks. And I'll give you just a few minutes here seconds to plug in as to whether you think it's going to be up or down for the year. And then I'll let you know what everybody decided. So, all right, answers are coming in. That's good. It's like watching a horse race. There's one leading for a little bit. There's another leading for a little bit, back and forth. All right. Boy, it's really moving around. You're all chiming in. That's great. All right. I'm going to go ahead and lock her down here. Any last entries real quick? All right. So from its value on September 30th, we saw the S&P down into the 3,700 range, the Dow well below 30,000, numbers we haven't seen in a long time. And so the question was, do you believe then from that point, which we've had two good days the last couple of days up until today, but from that point, do you think the market's going to be up or down for the end of the year? And so the answers bounced around pretty dramatically during this, but they ended up 50-50. So we have a complete consensus that it's 50% up and 50% down. So that tells us exactly what I believe everybody thinks. Nobody knows. It's just so difficult to determine what's the truth is, what's really going on out there. And so that's what we're going to talk about today. So I'm going to share a few slides with you. Again, I'm going to pop up the chat or the Q&A. So if you have any questions along the way, please include that. It makes this a lot more interactive and fun. And so, boy, I feel bad for this sad little gal. I found her picture and I'm like, wow, this is kind of how it feels to be an investor in 2022. We've had mean markets. There's been challenges across the board, and it's been coming in one stream or another. And everywhere you look, as I mentioned before, everybody's saying, boy, it might only get worse from here. And so that's what we want to talk about. All right, our quick disclosure here for everyone. Okay, so a few points we're going to talk about today. We're going through an economic process, and whenever you're involved in a process, there isn't going to be one day that we hit and it says it's over. If you point back to 08, or you point back to the debt Greek crisis, or you point back to the 02 technology challenges that we had, all of those times, there wasn't just a day that all of a sudden we said it was over. So I want to talk about that a little bit. I believe that small adjustments are things that we need to be thinking about. So when there's big changes like this, it can be very tempting to make big changes in a portfolio or big changes in a plan. And sometimes the small adjustments are actually how we get through this. The third is to be skeptical. A lot of news that comes out is difficult to disseminate whether it's either true and or beneficial. And so I want to discuss that. And then inflation and interest rates is something that you've heard me talking about well before we had inflation and interest rate problems. I was saying that we've had a 40-year bond run of a bull market in bonds. Interest rates were likely going to increase if we had inflation whenever that would come along. And then we now have a new word. So Marianne Bartles has joined Sanctuary. She is a former Merrill Lynch executive and ran a lot of their capital markets research and discussion at Merrill Lynch. She retired and spent a couple of years off taking care of her family, and has now returned as our chief investment strategist through my Sanctuary partner firm group. And so she introduced me to this word called episodic volatility. So we'll talk a little bit about that. I'm excited to have her with us. She's a wealth of knowledge. She's got great research pieces and things that she's been handing out that I'll be sharing with all of you. And I'm working with her and going to be working with her in the near term to have a call so that you can meet her and hear from her in the near future. So that'll be coming up soon. All right, so when I talk about a finish line, when I used to do triathlons, there was nothing happier, nothing better that came along than a finish line to say, this stupid thing that I undertook is just about to be over. And so in these economic times, we would love to see a finish line to say, all right, well, if this happens, if rates get to 4.5, this is over. If inflation comes down to 2, this is over. If unemployment peaks at 4, this is over. I don't think that's going to happen. It just doesn't work in this very sophisticated economic world that we're all a part of right now. And so all of these things, interest rates, inflation, recessions, the dollar, all of that stuff has to coalesce in some way, shape, or form to firm things up so that we can move into another economic recovery. Until they do, you're going to have episodic volatility. And so when you hear me use that word, no one knew a year ago that Ukraine and Russia was going to be a thing. We didn't plan for that. Russia may have had plans, but it wasn't definitely being transmitted into the capital markets. So that's the kind of thing that comes along that you just don't know. And when they come along, any sort of uncertainty creates volatility. Well, now we have a whole soup of it with all of this stuff that's going on. So inflation is trying to be suppressed by the Fed by raising interest rates. We've talked about this a lot. So they're going to keep doing that until they see the results. What they've done so far has done nothing. And so they're convinced they need to continue to raise at these episodic levels to get inflation down so that prices stabilize. Lots of things have contributed to this. We've had supply chain disruptions. We've had strange times in the energy markets with Ukraine and Russia. Just a lot of things have gone on to contribute to this. And then this last month, we saw gas prices start to come down. So I think we all believed inflation was really starting to moderate. Well, the print came out very high, well above 8%. When you're including food and energy and you're including things like rent that have gone crazy, well, these prices keep going up. So that's what they're trying to do, is raise interest rates. So people that are borrowing, companies that are borrowing, will have to slow things down a little bit. And they're trying to suppress economic activity. Well, obviously, if you suppress it too much, you get the word that's here in the middle, which is a recession. So that's what you hear every day. We're either in it or we're in the middle of one. One's absolutely coming in 2023. One's absolutely coming in 2024. Recessions are funny. They're, in many cases, a rearview mirror episode that you don't know that you were in one until it's over. And so while a recession is likely, they're not unusual. We've experienced lots of them. And to have one here, it's, what was the thing somebody was saying the other day? It's kind of a dog that's not able to bark. It could certainly be threatening and cause some heartburn, but very likely not to be a severe one unless there's a big policy mistake by the Fed. If they raise rates too quickly, don't allow things to work out, and all of a sudden we have these high rates and then all of a sudden very low growth, unemployment starts to spike. At that point, they'd have to react by lowering rates again. So those kind of levers that are all being pulled or manipulating this and at a time when the economy, just as a natural part of progression, is beginning to slow down. So a recession is likely, absolutely. However they define it is likely something that we'll be talking about into 2023. However, the market doesn't wait for a recession to end before it starts to behave differently. So I apologize that this is a little busy, but I just wanted to show you these gray bars here that I'm circling. Those are recessions. So you can see them lightly in here. Let me see if I can turn this up a little bit. There, you can see them a little better. So this just shows the unemployment rate and the stock market return after recessions. Those black bars in the middle here are the market low. So you look at 74, we hit a market low, unemployment rate and the S&P took off from there, but they were low when the market began to settle in and move up. So my point is, it doesn't wait. It's not going to wait until these things are cratering. You're not going to know that's happening before the market begins to recover and behave differently. And so it does no good to say, all right, unemployment's doing this, inflation's doing this, as we're moving through this process, say, all right, we've absolutely hit a low. The market will begin to move long before that begins to happen. Things will begin to change. So I just caution everyone, when you're trying to time things like this, it can be dangerous because it's not going to wait. And so if a recession is coming in 2023, I could argue that it's priced in already. And if it's a mild one, that it's priced in already with a 20 to 25% decline in stocks. And so it causes one to say, I need to check my allocation. I need to make sure I'm in a good spot. I'm not going to try to guess as to when this could change, because when it does, it's not going to wait for anyone. The last 2 days are a perfect example of, wow, 1,500 point move out of nowhere. I mean, like I said, last Friday, I read more dirgy news. I wish I could have clipped some highlights for all of you to see how, I mean, you see it too, but the sentiment across the Wall Street Journal, CNBC, the economists that I read, all this stuff was just blue, blue, blue. So anyway, let's move on to the next point. So small adjustments. So harsh, dramatic moves in the midst of a challenging market don't generally serve one well. It can be tempting to make big changes in your 401k account, in your investment mix, sell your stocks, buy some bonds. It feels like they're safer. All of those big adjustments, big changes, and many times you're either too late for them, or when it's time for the thing to recover, you won't get the benefit of that. And so when pilots fly, as my friend that's a pilot explained to me, they just make little tweaks along the way. They tweak it a degree here, a degree there, but they chart their course and they stick with it. And I think that's the message I would send, is that we want to look at brief little changes along the way here. On the stock side, I'm vehemently opposed and think everybody should be sticking to their allocation and or rebalancing in the midst of this, because of the reason I just mentioned. We don't know when things will change. This is a good time to make small adjustments in your bond portfolio, however, because that market has changed dramatically. With interest rates have gone up, we've seen our bond values go down. They're suppressed now in big numbers that we haven't seen in the past. Reallocating in a way that will allow you to take advantage of these new high yields without the interest rate risk is something that I'm working on for all of you. So if we're managing your portfolio for you out there, you can know that this is happening on your behalf. But if you're inside of a 401k plan or an outside investor, take a look at what's going on with your bond portfolio. This is a good time to make some changes and to say, am I allocated in a way that can help me recover from this a little bit? Is it maybe a time to buy more stocks with my bond proceeds? All those are kind of questions that we want to be asking ourselves right now. All right, another busy chart, but this shows intra-year declines in the markets and then where the markets ended up. So I've highlighted a few of them here. So if we look into like 2009, the market was down 28% and ended the year up 23. Dramatic example. We were coming out of a really harsh recession, all of that. I recognize that. So that's not always the best example, but you can see years where we've had 20% declines. And then, yes, we've ended down, but not nearly as dramatically as we were. And so this year, yes, down 25, 30% on the NASDAQ, the FANG stocks, the Facebooks, the Teslas. All of those have been hit really hard because they're very debt and interest rate sensitive. But as you can see, in many years, there is recovery. And so it just goes back to that point of staying the course with making small adjustments. All right, clear this off here. So chopped off the top of my slide here, but this is equity scenarios, bull, bear, and in between. And so when we talk about how can we get back to where we were? So if we're talking about being an investor, ideally we'd like to get back to where we were, to where we could say, all right, I've recovered my principal value. I'm starting to feel better about the markets, all of those kind of things. Well, if you stick with your allocations now and these markets recover over the next years, if we get back to where we were, so let's just say in 3 years, we get back to where we were in the market. That's a 40% over a 3-year period because you have to put the time value of money in there return. So that's 12.1% a year that your stocks would have returned to get us back just where we were at the beginning of this year. So I say that because I think we'd all be pretty happy with a 12% return. I think historically that's well above the average. So, and it gets even more dramatic as the time frame shortens. And so even over 5 years, saying that we've made 8%, wouldn't be maybe ideal from where we've been, taking it that long to get back. But again, an 8% return is something that in our financial plans is well above market, well above what we plan for. So something to think about there. All right. When I talk about being skeptical, what do I mean? I'm an optimist. I always think things will come out in the end. I believe the universe is a good place, that we're going to find our way through these times. And as much pessimism is out there, much of it's deserved. There are lots of bad economic headwinds. There are bad things going on in the world. The Ukraine-Russia thing is just a horrible humanitarian crisis. We've got lots of problems here in our nation. What I'm talking about being skeptical about is much of the financial press loves drama. Like an angsty teen that I put in the invite, in many cases they're selling advertising. So to sell advertising, you have to get eyeballs. You have to get clicks on your stuff. To do that, they'll throw headlines out like there's a market call that says the S&P is going to go down to 2,500 in the next 6 months. Or there is recession. I have proof that there's going to be a recession over the next 6 months, and it's going to be bigger than 2008. Or market pundit says that market's going to go up 60% in the next 2 days. You've got to get in now. It's crazy talk, man. So when you're hearing all this stuff, be skeptical. I think Bereni's quote here at the bottom, I need to move this real quick. We think one of the greatest traits, an investor have is a dose of skepticism. And so against all that conventional thinking. And so just asking yourself, is this really true? Does this pertain to me? What frustrates me the most is that we hear these forecasts, these prognostications, these guesses about what's going to happen, but they don't tell us what to do about it. Rarely will you hear someone that says the market's going to go down to sell everything. Oh no, you should just be diversified. Well, we were doing that. Your advice just scares me. It doesn't do me any good. So that's why I say be a little bit skeptical when you're hearing all of this, because some of it is true, some of it is false, somewhere is some in the middle. And so we just need to parse through the news that we're getting. I like this. It was attributed to Abraham Lincoln. How many legs does a dog have if you call his tail a leg? 4. Because calling a tail a leg does not make it so. So I thought that was pretty good. All right. We talked a lot about inflation, interest rates. I just wanted you to see that expectations on inflation over the next 5 years are coming down. So the 10-year average is 2.7%. Forecasters are saying somewhere in that range over the next 5 years. So while we've seen energy, restaurants, all those prices go up, you would expect that to moderate. Housing is a big thing, and it's not always calculated the same way for folks. Shelter is how they use it in here. I just know from practical use of my children in Denver and Chicago and people that I talk to, and Connor's looking for an apartment here in Des Moines, rents have gone crazy. All right. So let's think about this a little bit. If you're a landlord and you're able to charge these rents, you're going to have a lot of home building come online as a result. Those interest rates now to borrow to build those houses are going up. So while the rental market could actually expand, there's going to be a lot more inventory. Houses that are maybe being sold now that can't be sold because no one can afford it because rates are so high are now going to rent that house, and they have to bring that number down. So all the things that they're doing with this inflation manipulation is going to have an effect. And so nationally, I've got this article here this morning. Nationally, the average income required to afford an average mortgage payment has risen 88% since 2020. Read that again. the average income required to afford an average mortgage payment rose 88% since 2020. Mortgages are at 7%. So if you're a young family planning to buy a home, you've been in the market, and now in the last 6 months, you've just kind of been waiting because you thought the market would calm down. Well, you're going to get your wish, but you may not be able to afford what you want to buy, because now all of a sudden your mortgage payment could be double what it would have been before. This is all going to show up at appliance stores, in the way that people travel, just overall consumer behavior. And consumer behavior, consumer expenditures are what drive this economy. They are what bring in GDP growth over time. And so that is going to have to get itself corrected. And that's why you're seeing so much worry, because they feel like if they raise rates too high, it's going to bring that down too fast and cause a deep recession. And so that is the balancing act that they have to do. I would wish that the Fed would be a little more patient and see how these things translate into the economy before they keep raising rates so dramatically, but they haven't called and asked me how I feel. So that's just my 2 cents. All right, what do we do? It's always good just to say, where should I be looking for opportunity maybe? So I do think parts of the bond market will become attractive. I don't know that they're there yet. I think rates have to moderate in that probably 4.5% to 5% range from the Fed before we'll see the evidence of that. But certain areas of like the Iowa municipal bond market, some of the treasury bonds where you can now get yields on those that weren't available in the past. Getting 4% on a shorter term bond was unheard of a few years ago. I haven't seen in my career since I was back in Colorado as a banker, renewing CDs that came off of 13%. We had to renew at 4%. And I had poor ladies crying in my office because their rates had gone down so much. So this is a whole new phenomenon. And for the retirees out there, in some ways, this will be good news, because you'll be able to get yields again on some of your bond portfolios that can pay your income that weren't available before. Dividend paying stocks are a bellwether. They are always paying you income. If they can pay a dividend, it means their balance sheet's pretty solid. If they've been a dividend raiser, like Leggett and Platt, some of these companies that have raised their dividend, in that case, over 50 years in a row, and you can make 4% there, that's attractive, because you're getting a 20% discount in some cases on the stock itself and this dividend yield that then brings your risk down. So perhaps tax harvesting is something to look at. We've been doing this for folks all year. If there's an opportunity to take a tax loss but stay invested, we've been looking to do that. Broad market fixed income, so some of these ETFs, exchange traded funds that have a lot of exposure to interest rate risk, those are areas that we're continuing to trim and reallocate. Your stocks, like I said, I believe we need to be holding here, keeping a little bit more of what I call a value bias, which is a buy low, sell high, the dividend area, all that. The defensive boring stuff, think of that: utilities, healthcare, energy, blah, 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 stuff that we haven't been buying for years because it's all been Facebook and Netflix and Meta. And so, the regime change has added a little bit. Now you can get higher yields on your cash. And so stable value funds inside of 401k plans, things like that, if you are getting close to retirement, all that kind of thing might be something to look at. So, and then always, Roth conversions, doing some of that tax loss harvesting, all that kind of stuff is a planning opportunity that we can all be thinking about this year too. So, all right, we began with a very, very sad face. I'm going to end with a very, very happy one here. So it just makes me laugh looking at her. So, don't worry, be happy. I know that's easier said than done. Perhaps you think I see the glass is a little too half full, but I just know that these times don't last forever. And I think the process of this is going to begin to take hold, and we will have volatility. We're moving into an election. That's always going to create volatility as polling comes out and all that kind of stuff. So be aware of that. Want to let you know the chamber has offered kindly to host a party for us here on the 18th. It's going to be at our office, and from 4 to 6, we'll be sending out an email as well with a follow-up. But I just want to put it on your calendar. So it's from 4 to 6. We're going to have, snacks and stuff like that. I'm going to talk a little bit about the book and be handing out some free copies with the drawing and that kind of stuff. So if you can stop by, we would sure love to have you. Let me check into the chat here. Or the Q&A. All right, if there's any questions, this would be a great time to throw them in there. I'm happy to hear from everybody and answer what I can. Again, lots of reasons to be pessimistic, but also lots of reasons to expect that things will moderate over time. And so unlike other times where I've said, boy, don't do anything, just rebalance, I am saying this is a time to be looking at bond holdings and making some shifts there. And so we're hard at work doing that. And then for any of you that have specific questions about your situation or your plan, or how is this going to affect my cash flow, or should I be thinking about doing something different with my home? That's what we're here for, to help answer those questions, to make sure it's all part of your planning process that we have everybody go through here at Prairie Fire. And so eager and anxious to help. So, all right, any questions coming in? All right, I am not seeing any. So we had a big attendance today. I thank you all for coming. I hope this was helpful. Appreciate your feedback. Always welcome just to email me if you'd like. If you had something in particular, your situation that you want to take offline, I'm happy to help there. So in the meantime, please be well. Know that we're hard at work here for you and available to answer your questions, all those kind of things. So before we go, I did get one. All right, thank you. What impact do you think the November elections could have on what we've discussed today? So it's a great question. I haven't seen a lot of polling yet to say. I understand the general gist of the election is that the Republicans could gain some seats in the House, but most likely not take over the Senate. And so that sounds like to me a ripe environment for gridlock. When you have gridlock, what you're not going to be seeing is tax policy change. You're not going to be seeing big legislation come through. I firmly believe that a president's first 18 months is their time to be most effective. And if you look back at the Obama administration and the G.W. Bush administration, Bill Clinton, that's when they were getting lots of things done, is in those first 18 months. Because after that, you move into midterms, and then you're working on reelection. And so if the midterm delivers a huge mandate like Newt Gingrich's did or some others, yeah, then you can maybe see some legislative pivots. But if the scenario as it plays out today comes out, we'll have gridlock, and then very little will be done at all. So if the Republicans were to win a favor, I'm guessing they would get to work on something around energy and opening up energy markets, things like that. I think continued social policy reform, stimulus to the economy, perhaps, all those kind of things, if the other scenario was to take place. So what will happen as far as what we talked about today is, I think, very little as far as how the Fed behaves. They're not going to care about the election. They're going to be watching the numbers and the data. And so if the market's volatile because of election news, it's due to the polling and what they think will be the legislative result of that outcome. And so I think that will have a lot more impact on the stock market. The bond market is going to be driven by the Fed and what they're doing with their interest rate and inflation scenarios. So I don't think the election is going to impact that longer term issue of, will they throw us into a recession? Will they keep raising? All of those questions that we kind of had on the front page. What it could affect is just some regulatory setups, things like that the market will either perceive as positive or negative and react as a result. Those are short-term changes. So I don't think this is an election that's going to create a lot of change in the economy or the market. I could, of course, be wrong, but that's my opinion on that. So thank you for that question. Any others before we sign off here? All right. Sounds good. Well, thank you again for joining us. I want to leave you with this happy face again. So everybody be well. Thank you so much. We'll talk to everybody soon. Thanks.